Good evening, everybody, and welcome to tonight's webinar on Mortgage Mastery. I'm Shelley Palman, and I'm a strategic coach here at Enable Me. Now, you're here because you got a mortgage and you want to do something about it. And I'm going to throw down a challenge to you tonight. If you've had a mortgage in the last couple of years, it hasn't been very nice, has it? We're about to come off a pretty gnarly interest rate on that mortgage. We've been short fixing in the hopes that it will come down, and rates have come down. So what are you going to do with it? Are you going to grab it and put it towards helping you get ahead faster? Or are you going to squander it and stay stuck in that same old rut? Be honest. That's the challenge to you. This time next year, where are you going to be? Ahead or still in that rut? Today's webinar is all about taking action. So let me set the agenda for the session tonight. I'm going to take you down. I'm going to drag you down before I build you back up again. I'm going to talk about some home truths about having a mortgage in New Zealand. It's not great. The system here, it's a little broken, and we need to be smarter to hack the system in New Zealand. I want to talk about the real levers to help you get ahead, not just the stop buying coffees and avocado on toast. What can we actually practically do to help you take control of your destiny when it comes to getting ahead faster, clearing off your mortgage and growing wealth? How do we grow wealth, and what is leverage? I'm going to cover that off in today's session as well. I'm going to tell a couple of stories about some clients, and hoping we have time for some questions and answers at the end. Oh. Okay, I think you can see me now. Thank you, Olivia, producer. Apparently people couldn't see me, so hopefully you can see me now. So if you have any questions that you think of during the session today, some of you have sent some through ahead of the session today, but if you think of something and you have that burning question, there is a Q&A box somewhere on your screen. Pop it in there and we'll hopefully get a chance to cover that off at the end. So this is me. I am a financial advisor. I am a strategic coach. I invest in property, and they call me a straight talker. I call a spade a spade. I think you do people a disservice if you tell them what they want to hear. So when people come to see me, and I hope to see some of you following the session tonight, I'm just going to say it how it is. And I'm saying it in the context of, I see what's going wrong here, but here's what we're going to do to correct that, to get you to where you need to be. So I am a straight talker. I am brutally honest, but it's in the context of, well, what can we do about it? So as an Enable Me coach, my job is to help my clients get the best out of their situation and motivate them to get ahead faster financially. So today's just general information. If you want specific financial advice, you need to come and see a financial advisor. So it's not intended as a substitute for regulated advice. You need to come and see us for that. So I hope you take a lot out of the session today. However, there's lots of good stuff in here. So let's start with a poll. Are you mortgage free? Are you one of those lucky ones? I'm picking probably very few on the call will be, otherwise you wouldn't be here. So options there, you're trying to get on the ladder. And hey guys, now's a really good time to do that. I want to understand if you have less than 15 years or more than 15 years, or whether you might have some mortgages possibly on an investment property or two. I'm always surprised at people not really understanding the mortgage term. So I don't mean, oh, my mortgage interest rate that's rolling off at the end of this year. I mean that horrible 20, 50 something. That's your term. So yep, we've got nearly 60% of the people on the call, more than 15 years. So you're all here, you're in the right place. Okay, cool. I'm going to close that off. Good to know. Okay, I'm going to get my button working. So financial freedom, what is it? In my mind, it's ability to choose. So for some of us, that means, you know, having the ability to pick up that hobby that we always wanted to do. It means having the choice to help our children go into those hobbies or those extracurricular activities. Choice around the work that you do, and choice around how much you work from a certain age. That's a common one that people come to me about. For me, that represents financial freedom. And it's interesting, we've put here on this slide, stability through volatile times. We're going through volatility at the moment. There is lots happening out there at the moment. And you might think, well, Shelley, what does financial freedom have to do with stability? But in my mind, it's that base level of feeling secure financially with a plan that allows you to have that freedom and that freedom of choice. I think for a lot of us, it's just being able to sleep through the night, having that peace of mind that we're doing something about this. We're not just accepting the default position. So what are the current mortgage realities in New Zealand? It's not great, I'm afraid. This is the bit where I tear you down before building you back up again. 46% at the moment of New Zealanders' gross median household income, so the median income at the moment, is going to their mortgage. So nearly half. What that does is it means that everything else has to happen within that other half, that other 54%. So we have to raise children, we have to unfortunately feed them and house them, and maybe try and have a little bit of fun along the way. But it all gets squeezed into the other half because our mortgages are taking up such a big chunk of our income. There's been a lot of research done around mortgage stress, and there's been a little bit of research done by FAM NZ, their mortgage brokers. Mortgage stress means we're not sure if we can make the next payment, we're not sure if we have to call the bank and try and go interest only, and just generally feeling really worried around our mortgages. It's driving a lot of people to come and see us at the moment too. 59%, that's nearly 60% of mortgage holders are feeling really stressed around their mortgage. Now, the next stat is really scary, and this has been taken from Centrix in March this year. 23,700 mortgages have actually missed payments. So it's not even being worried. I mean, we're not paying our mortgages. We're missing payments, which is a major concern, and that's been an increase from the last time that was measured. So what happened within the last 10 years to kind of add this extra stress onto everybody is that there was a really big upswing in the property market, and there was a really big jump in the average first home mortgage and the average first home price, hence the first home mortgage. So the average first home mortgage 10 years ago was 300,000. You might think, oh, chump change, compared to my mortgage, but it's still a lot of money. But now it's even worse, and that's happened over a very short period of time. So we know that wage growth definitely hasn't kept up with that. So this is a major concern. The system that kind of worked for our parents and our grandparents really isn't working for today's first home buyers or people who have mortgages. So that's an issue. The other issue that we're facing at the moment is it's just feeling a little bit noisy. There is a lot happening in the world from a macro sense at the moment. And whether it be trade wars, whether it be actual wars, whether it be, high inflation and cost of living, volatility in the market is happening at the moment. You might have seen your KiwiSaver jumping around a lot recently. Unemployment is creeping, and the economy is just in a really stagnant place at the moment. So, it's not feeling like a great time out there. But do you know what? Having that negativity bias, it drives a lot of fear. And I'm here to tell you to just, be informed, get the right advice. But actually, we need to block a lot of this out. We can't control it. We can't control what other governments are doing in terms of their trade policy. We can't control the fact that there's a war happening. There's nothing to do with us. The markets are going up and down, but we can't change that. So I want you to move the focus away from worry and fear and negativity into, well, what can I do about it? What are the things that I can control? I think, as I said before, the biggest risk is doing nothing. And that cost of doing nothing, sometimes I quantify this for my clients. So I say, people think, oh, well, there's so much volatility. I won't do anything. It's not the right time to do anything now because the markets are too volatile. And actually, I think interest rates have a little bit further to fall. So I'll start on paying off the mortgage faster when the interest rates drop. That's when I'll start. And we often get people saying, well, what I'm going to do is I'm going to watch some webinars and I'm going to follow some influencers on Instagram and TikTok. And I'm just going to do this myself. I think I can just figure this out. I'm just going to DIY it. I don't need any other advice. And a lot of people think, I'm just going to wait until the economy recovers and then I'll do something. I'm here to tell you that there will never be the perfect time. You know, I often have clients come and see me and they say to me, Shelley, I should have done this 10 years ago, 20 years ago, 30 years ago. And I go, yeah, you should. So I'm here to tell you today, just start. We just need to execute and we need to just do something. So a lot of people think getting ahead, and like I've said earlier, we should be getting some, little tailwinds in terms of, a little bit more cash in our pocket. Mortgage rates are dropping. We're coming off those higher fixed interest rates. That literally means our repayments will be lower. There's more money in your back pocket. But it's not necessarily about timing an interest rate drop or waiting for the economy to recover. It's what can we control? So here are the things that we can control. Look at yourself. At the moment, if you're not able to get any kind of increase in terms of your pay, focus on your strengths, identify the areas that you need a little bit of help on, focus on what you're good at, do some personal reflection or self-awareness. There's a couple of different personality profile quizzes that we get our clients to do. Do a SWOT analysis on yourself, invest in yourself, do that course, get the knowledge. But I think focus on you in this situation. Ignore all of the stuff that's happening in that kind of wider macro sense. I want you, and this is a job for you who are listening, this is a job for you to do at home, define your starting point. A lot of people, they don't really know where they're at financially, or perhaps one person does in the partnership and the other person doesn't. So I want you to sit down and define your starting point. That looks like, if you own a home, what is the value of your home? If you have a mortgage, what is the quantum of your mortgage? What's the difference between the two? We call that your net equity position. How much are you earning? What is that income that comes into your bank account every fortnight or every month or for the year? And how much are you actually saving? So that's what we call your starting point. Look at the problem you're trying to solve. And for some of our clients, they need us to do that for them. There's a little bit of a complex calculation around retirement, how much you're going to need for retirement. And often you may or may not realize that you're actually tracking to have a retirement shortfall. So if you are, what is the quantity of that shortfall? That's what we call the problem that we're trying to solve for. So what can we address now as part of your financial strategy to make sure that we course correct and we don't have that shortfall at that point in time? Timeframes are really important. How long do you have? Money, it's a finite resource. You can't work until you die. Well, some do, but you don't want to have to, right? So how long do you have before you turn 65? And that's the default retirement age in this country. What is your time horizon? We like to call it your runway. Are you running out of runway? How long is your runway in terms of work? And what are those behavioral tendencies? So are you disciplined? What is your stickability like? Let's leverage off your strengths to help you get ahead. So these are the three basics in my mind that you can focus on whilst ignoring the media noise around volatility in the economy and wars. So number one, we want you to maximize your savings. We call it your annual surplus. How much is coming in the door and how much of it can you keep? So for a lot of our clients, and I'm going to talk about fritter in a minute, we want to identify that fritter and put it to better use. So step number two is, after we've got some really good systems in place and we're not frittering, we've identified what that is, we just want to get rid of that home mortgage. If you're sitting here tonight and you have investment property lending, let's park that on interest only. That's tax deductible debt. Let's focus on the home mortgage. Your home is a lifestyle asset. So we just want to get rid of that mortgage as quickly as possible. That's going to give you financial freedom. And the third step is build wealth. And we think it's a really good idea to do that through leverage. So 3 steps. First step being maximize your savings or your surplus. So we think here at Enable Me, this is a Enable Me-ism a little bit, but tends to be right 9 times out of 10 when I'm talking to people about how much I specifically think they are frittering. So fritter could be food, and in fact, that is a big source of fritter. That 5th trip to the supermarket, that work lunch that you didn't really need, that third coffee for the day. Food and drink, whether that be at the supermarket or eating out, is a huge source of fritter. So we need to put some systems around identifying a weekly amount that we intend to spend on food. Pop that into a bank account. That's what you've got for the week. Hold yourself accountable on a weekly basis to sticking to that amount. Things like subscriptions, how many of them do you have? You kind of add them on, and this sounds like a good idea. And before you know it, it's a couple of $100s a month. So are you actually watching all of those subscriptions? That lazy tax, are we using bank accounts that charge us a fee? Have we not done any kind of rationalization of our utilities? Could we get a better deal elsewhere? The biggest form of fritter, in addition to all of those, is your mortgage and the amount of interest you're paying on your mortgage. Not having an optimal mortgage structure is costing you interest, what we call compound interest, that you're paying to the bank. And I'm going to talk about that a little bit later. So it's not about the interest rate, although it's great to have an interest rate, and we've got tailwinds with lower interest rates now. It's about paying off extra principal on your mortgage every year over and above what the bank want you to do. That is the key to crushing your mortgage. So you might ask, why would I pay off my mortgage, Shelley? Like it is what it is. I've got 15 years. I want to live my life and I'll pay the mortgage off. I'll get it done in time. So you want to get mortgage free before you hit retirement. Obviously, we don't want to have a mortgage in retirement. That's going to erode your retirement savings real quick. And you definitely don't want that as an ongoing cost. I also don't want you getting mortgage free just at age 65. Let's buy you time to get mortgage free, so we've got extra runway to really sort the kind of retirement that you want to have. The faster you pay your mortgage, the less compound interest you pay to the bank. And I always say to my clients, $1 you pay more now on your mortgage is $1 less that you're paying compound interest on over that 30-year term to the bank. The sad fact in New Zealand is that the compound interest that everyday Kiwis pay on those table mortgage loans, unfortunately, ends up going to Australia, unless you're with KiwiBank or another New Zealand bank. Majority of it's actually going offshore, which is not great. So why else would you want to pay off your mortgage and accelerate the pace at which you pay it off? Opportunity to leverage. So thinking about the value of your home and thinking about the value of your mortgage, if we're driving down the value of your mortgage by paying it off faster, and over time the value of your home increases, what we're doing there is we're creating equity in your home. And that equity, we can actually put that to use to grow our wealth by borrowing against that equity to buy another property. And I'm going to talk about that shortly. For now, I just wanted to illustrate the difference that paying your mortgage off faster can make. So before, when I said compound interest, not so great on the table loan, unfortunately, a lot of people have higher mortgages than this, but the average first home mortgage at the moment, according to the Reserve Bank, is $550,000. So on a mortgage rate of 4.99%, if you just pay that off over that 30-year term, you're paying essentially double on that 4.99%. If you're on a slightly higher interest rate, it can be more than double the quantum of that mortgage. If you pay that off in 15 years, amazing. That's going to save you quite a lot. We really want to target you paying your mortgage off in 10 years. If you pay your mortgage off in 10 years, as opposed to 30, you could save $360,000. That's money that you can have in your back pocket rather than the bank's. Let's do that, huh? So on the next slide, this is if, and when we're talking about the average first home mortgage, often that first home just doesn't quite cut the mustard. And a lot of us then upgrade our home and we take on extra debt. So obviously the higher your mortgage is, the more compound interest you pay. So in this particular example, if you do it in 10 years instead of 30 years, over $500,000 of interest that you save. So what are your different options with your mortgage? So there's the 3 R's. You could refix when that mortgage comes up at a lower rate. You could refinance, or you could restructure. Refixing, pretty much, you might like to refix and keep the payments high and keep them at the same rate. A lot of people do this. It means you're hitting extra principal, which is good, but it's not actually a very flexible way of paying off your mortgage. And even if you refix and you keep the payments the same, even though the interest rate has dropped down, great. That might take a 30-year term to 23 years, but still 23 years. It feels like a really long time, even though you've increased your repayments. You're putting yourself under cash flow pressure, and it's not a flexible way of paying off your mortgage. So we don't recommend just increasing repayments or leaving them the same if the mortgage rate drops down. A lot of people are refinancing at the moment, and the brokers are pretty busy shifting people to different banks at the moment. A lot of my clients are doing refinancing. The benefit of doing a refinance is you might have a couple of different loans and they might be on different terms. You might have done a renovation or bought a car, and you've kind of got scrappy little bits of mortgage and you're not quite sure what the term is, and you're coming off at different times and you just feel a little bit out of control with your mortgage. Or you might be on a really tight term with your mortgage, or you might just be looking for a cash contribution from that new bank. So when you're looking to shift to a different bank, often that bank, if they like the look of your deal, will give you cash to move to them. And it can be, if you've got a large mortgage, thousands of dollars. So why would you not, right? But with a refinance, getting that extra couple of thousand is great, but what are you going to do with it? Are you just going to kind of carry on doing what you always did, and then you just spend that extra 2,000 that you got from the bank? So refinance can be good. You might get a better deal, but we still need to be cleverer with our structure. So here at Enable Me, we believe that regardless of the bank, we want to have an optimal mortgage structure. So we call that a mortgage optimization. We want to be able to pay our mortgage down faster, but we want to do it on our terms, not the bank's terms. So what does that look like in practice? Once you've identified how much you can save, so, okay, you get 100,000 in the hand as a household. I said, if you're frittering 15%, therefore that's 15,000, right? Let's take that 15,000 and channel it into the mortgage. Kiwis get really overwhelmed with that 30-year mortgage term. So human nature, like I said before, even if you increase your repayments, it might take it to 23 instead of 30 or 19. It's still a really long time. What we do here at Enable Me, we break the mortgage down into savings targets. We identify what we can save and we break it down into bite-sized chunks. Then we can measure you paying those bite-sized chunks off every year, and you feel like you're making progress. So what we do with your year one target, once we understand what that amount is, and if you've got some savings sitting in the bank, I would actually add that on to what you think you can save moving forward if you're minimizing fritter. And that's what we want to chip off your mortgage. And we want to create what we call a revolving credit, which is essentially a floating loan. But the benefit of a revolving credit is that you can transfer back out of it again. So we take a piece of your mortgage, we put it into the revolving credit, and then we set targets to pay that back over the first 12 months. Anything else, we fix. And for a lot of my clients, they want to identify, well, Shelley, what do you think we can pay off in year two? And we fix that for a 1-year period. So assuming you follow the plan, you pay that revolving credit back down to zero by the end of the year, the bank will then say to you, hey, you've got this 1-year fixed interest coming off. How long do you want to fix it for? And you're going to say to them, I'm not fixing that at all. I'm going to make that my target for year two. We pop that on top of the revolving credit, and that's what we aim to pay back down over that year two. So what we're doing while we're paying down your mortgage, we're increasing your buffer and your financial resilience, which is so important when there's volatility in the market, there's risk of redundancy and in the job market. So we're paying off extra chunks of principal every year, shaving bits off your mortgage to kill, but we're also creating a buffer at the same time. So worst case scenario, something happens, we can eat back into that revolving credit if we need to. Ideally, we don't, but we've got that buffer there. And when we're talking about emergency buffers, I want you to have a minimum of 6 months of your expenses. 6 months of your expenses somewhere, not in a savings account. If you have money in a savings account and you have a mortgage, what you're actually doing is you're giving the money to the bank for them to then lend it back to you at a higher margin. So if you have a mortgage and you have savings in the bank, please don't. The bank are winning. They're gaming you and they're winning. Let's employ that revolving credit. Take a piece of your mortgage, transfer the savings in. That's where your buffer sits. We don't pay interest on anything that's offsetting. And we rinse and repeat that every year until the darn thing is gone. Okay, so creating leverage. We're on our way. We're minimizing fritter, maximizing our surplus, and we're on the way to crushing our mortgage. What is the next step? So we talk about retirement gaps, and for our clients, we actually calculate that. We build a giant spreadsheet for them of the rest of their life until they are no longer on this mortal coil. And year by year, we take into account their annual spend, their kind of what I like to call their operational spend. We take into account whether they need to help their children. We take into account those bigger spends like replacing a car, a bigger trip, a bigger spend on the house. We put that all into a big spreadsheet. We take into account their KiwiSaver, their mortgage trajectory, and any savings that they can make after they become mortgage free. And then we understand, well, how long is that money going to last them if they spend at the same rate? If there's still a gap, once we've factored in all of the KiwiSaver and all of their ability to save after they become mortgage free and all the time working through to age 65, if there's still a gap, and if that gap is more than 300,000, you are likely to need to use leverage. Remember, we've thrown everything in here, KiwiSaver, savings, getting you mortgage free. If there's still a gap, we have no option but to leverage. And I think if you're getting mortgage free and you're creating that equity in your home, let's get it working really hard for you. So, question to you guys, do you know how much you need for retirement? You could jump on sorted.org, you could try and do the giant spreadsheet, you could come and see us to do it for you. But are you on track, or do you feel that you're on track for retirement? Knowing your retirement number is the first step. So there's been a little bit of research. So Massey Uni do some retirement expenditure guidelines. So to give you an idea, a couple living in a metropolitan area where there's kind of things you can do, movies and restaurants and shows and things like that, are likely to spend just shy of $80,000 a year. So you think, okay, the pension is 49, I'm spending 79. I need to find 30 per year for 25 years or more, let alone if you want to retire early, plus replacing car and helping the kids and going on holidays and. So you could do the calculation, or you could get us to do it for you, but it's really important to understand your retirement number, because then we can understand, well, how do we correct for that? What is the level of growth we need from your investments to close off that gap? And likely we do actually have time, because you think, oh gosh, I'm in my 50s, I don't have much time before I retire. But remember, your investments last you all the way through retirement. Well, that's the idea anyway. So we do have time, and we can get growth through investment. So this is just a graph showing, if you were to, and I guess the dotted line is the average age to get on the property ladder at the moment is age 35, and the average mortgage term is 30 years. So the math doesn't really work there, does it? You arrive at age 65, having just become mortgage free, and you've got to hope your KiwiSaver cuts the mustard. It probably won't. So if we can get you mortgage free 10 years earlier, we improve your baseline. So you can kind of see like, okay, great, we get you mortgage free 10 years earlier at age 55, buys us time to invest and to save ahead of you finishing work. You can see your KiwiSaver kicking in there, and then likely that's going to last you a little bit longer. But what we really want to understand is we want you to get out to age 90. So how can we grow and get the most out of your investments to make sure that they do actually last right through to age 90? That's our kind of default position. Okay, so why property? Well, property is probably one of the few things where you can actually borrow to buy it. You can't just turn up to your bank and go, hey guys, want to buy some crypto? Can you lend me some money for that? You can't borrow to buy shares on the share market. You can sometimes borrow to buy shares in the company that you work for. So there's certain circumstances you can borrow to buy shares. You can certainly borrow to buy a business, but mostly you borrow to buy property. So leverage simply means borrowings. So why property? Because of leverage, not because property is amazing, but because of leverage. Property tends to outperform other asset classes because of the element of leverage. property's actually less volatile. And it's interesting. I often go back and I look at historical investment returns across the different asset classes. And you look at property and it has this beautiful smooth, it kind of goes like this, and then it goes along, and then it goes like this, and then it goes along. You overlay the share market and it's doing this up and down. So shares are very volatile comparatively to property. And for some people, they just like having property in their investments because it adds diversification. It's bricks and mortar. Someone's always going to need somewhere to live. So they like to have that diversification of their portfolio. But this is a beautiful illustration of the power of leverage. So say, for example, you happen to have, if you're so lucky, $160,000 to invest. Possibly we got a small inheritance or a windfall, or you might have saved that if you're lucky. 160,000 in a managed fund. Remember, with managed funds and any kind of sort of investment fund, you're paying fees on that, particularly when it's an actively managed fund. So you have to take into account, okay, I might be getting a really good percent on average over the years in my growth fund, but we need to back out the fee and we need to back out tax off that. So the average growth fund, you may be getting between 9 or 10%, but by the time we adjust for fees and tax, it comes back to about 6%, what we call net return. So on the 160,000 in a managed fund, you would expect to get 9,600 on average over the years from that managed fund. I mean, amazing. That's 9,000 you didn't have to earn. That's passive growth, which is great. But say you took that 160,000 and put it in as a 20% deposit on an $800,000 investment property. Because you've bought a higher value asset, you get to keep the gain on that higher value asset. So historically, the capital growth rate has been around about that 6% mark in New Zealand over the last 30 years. So going forward, you would be getting or expect to get in the region of a 6% return on 800,000 rather than the 160. So the return to you, obviously, once you realize that return over time, averages out to be about 48,000. Quite the difference. And that's how leverage works. So I wanted to give a client story because I think it's great giving data, it's great talking about leverage, but this is a real life example. And I loved working with these guys. They're actually clients of mine. I've obviously changed their names. They came to me feeling very stressed. They had a high mortgage. They had a couple of children. They were trying to juggle just life and they were feeling really stressed about the mortgage. They knew they also were not really on track to be where they needed to be because they were starting to get to their late 40s and their mortgage was still really high. So I got them working on a mortgage plan, and I'm happy to say that actually they are very close to becoming mortgage free on the home. But part of the journey with these guys was the equity they created in their home by accelerating their mortgage repayment. They leveraged off that in 2020 and they bought an investment property in Papamoa. So they bought this investment property, 665,000. This was a 3-bedroom home in Papamoa back in 2020. It actually went up to $1 million at the height of the market. It's come back down to a more reasonable level now, around about that 860 mark. That's 195,000 of capital growth that they got over a 5-year period. So this is a beautiful example of they couldn't see the wood for the trees. We got the mortgage strategy working. We set up the systems to get the mortgage free faster, and they leveraged before they became mortgage free. So I know with these guys, if they hold this property for another 10 years and we see that next property cycle through and they then sell that property, that's going to offset their retirement gap of 550,000. So pretty cool real life example. They bought me a bottle of champagne for Christmas last year. They're very happy. So people are feeling like, and this is a common question we're getting at the moment, is it the right time to invest in property? And as we always say, there's never the perfect time. You just need to do. Execution is key. But there's been a lot of concern around the soft rental market at the moment. And we're certainly seeing this in Auckland at the moment. There's less demand for rentals. You know, renters are being a bit more picky. There's a bit of an oversupply of townhouses, particularly in Auckland and in some of the regions. What we want to do is we want to identify when you're investing in property, well, what are those risks? And this is one of the things that we always consider for our clients when we're helping them on that investment journey. So when the rental market is soft, there tends to be what we call a flight to quality. So tenants are going to go, if they had a choice between two properties, three-bedroom properties for the same amount of rent per week, and one of them was an old dunger that was really drafty and cold, and the other one was a brand new, warm, healthy, home compliant property, they're going to go for the healthy and warm home. So for our clients, we always recommend to buy new. It reduces the risk of repairs and maintenance as well, which is another risk that we need to mitigate for. We'd always recommend working with a vendor or a builder who has a rent guarantee. So this is a really good way, and in fact, the clients in the scenario on the previous slide, they did do this. So they worked with a developer who had a rent guarantee. So for the first 2 or even 3 years, if you have to rent the property out for below market rent, the developer will actually top up the difference to you, so you don't feel that in your back pocket. For a lot of people, for a lot of my clients that are freaking out about, oh my gosh, my house is never going to get rented out, it's going to sit vacant for 6 months or 12 months. In my mind, it's not a risk of it sitting vacant for a long period of time. The risk sits in terms of you having to meet the market and drop your rent to get it rented. So when we're doing our projections around how much do we need a property to rent for over the period of time you're holding it for, we want to allow and factor that into your financial plan to allow wriggle room. What do we do if property values drop? We don't sell. We wait for that next cycle. So we always really coach and help our clients to understand what that property cycle looks like. And everything goes in a cycle. There's an economic cycle, there's an interest rate cycle, there's a property cycle. Where are we at now in the cycle? We're at the bottom and we're starting to see the recovery. So I would say we've passed the bottom of the market now. We're starting to see that coming up the other side, what we call the recovery. So we're in that point where it may plateau for a while and then it goes crazy at the top of the market. So that's kind of where we're at the moment. So what drives capital gain with property? Absolutely the cycle itself. So the property cycle, the interest rate cycle, people freak out when interest rates get high and it puts them off taking action. But when interest rates are low, and they are at the moment, it might help people to feel more secure, certainly about those first couple of years of having that property. The location makes a really big difference to whether or not that property is likely to go up in value. So when you're looking at buying an investment property, what is the council doing in that area? Are there new schools going in? Is there another subdivision planned? Is there roading? Is there infrastructure? Is there an oversupply in the area or an undersupply in the area? Those are the things that feed into capital gain. The property type. So we generally would advocate for trying to get a standalone property if you can afford it. If you can't afford it, you might need to look at more of a townhouse or a duplex or something like that. But a nice, new, warm, dry home for someone to live in and someone to rent off you. Net migration, and for those of you who don't know what this is, it's how many people are coming into the country versus how many people are going out of the country. So are there more coming in than going out? So when net migration, when there are more people coming in, that drives demand, which pushes up capital gain, and of course, timing of the property cycle. So property is not the only way you can grow your wealth. Lots of us will have our KiwiSavers. The KiwiSaver forms a really big chunk of your retirement savings, particularly if you're younger. It's going to grow to a reasonable level. It's probably not going to be enough, but it will form a big chunk of it. Property is an option, but there are all of these other different options. And I think you need to do what's right for your financial plan. So it's not saying gold's amazing. It's having its bit of day in the sun at the moment because it's a commodity. There's volatility in the share market. People go to things they know. Bonds and fixed interest investments are having their day in the sun at the moment as well because there's been volatility. But, you know, I think the key from this slide is there are lots of different options for growing your wealth. It's just what is the right mix for you. So, like any good plan, we need to understand the problem we're trying to solve. What is your retirement number? Are you on track for it? Houston, do we have a problem or not? We want to understand your financial tendencies to hack yourself, to make yourself do better financially. Let's remove those inefficiencies by creating better systems around your money, ensuring that you save first, channel that towards your mortgage. Really get that wealth mindset, that abundance mindset. What are the opportunities that are out there available for me that I can take today to help myself get to where I need to be? The focus, if I haven't been obvious about it by now, is on execution. It is great learning. It is great doing that knowledge. Absolutely, you need to do that. But the key is in the doing. And like any good plan, it needs to be flexible. If something goes wrong, we adjust, we reset, and then we just go again. So working with a coach, yeah, I'm probably going to tell you things you don't want to hear. The power of working with a coach is that accountability. It's that stretching you to do better and holding you accountable to any plan. That is so powerful to getting ahead and taking action. So the key takeouts from the session today: lower interest rates are great. We're getting them now, but that's not going to be the thing that solves the world's problems. We need to be taking action. We need to maximize your surplus, kill that mortgage down, and understand how to grow your wealth and how much wealth you do need to create. We've got to get a strategy and a plan in place. Number two, understand your behaviors, your capacity to take risk or your capacity to invest, and how that kind of feeds into the whole plan in terms of your investment pace. And paying off extra principal on your mortgage is where the gains are to be made, not in quibbling on interest rates. Doing nothing is the biggest risk to getting ahead, actually. Don't lock and leave, and just get out there and execute, guys. So you've seen me, you might have seen Hannah, you may have seen my colleague Katie Wesney on one of these webinars or on podcasts, but there is a whole team of experts here at Enable Me, and here they all are. We have chartered accountants, we have banking industry experts, we have even a ex-school teacher on our coaching team. So when you work with Enable Me, you're not just working with one person. There is a whole team behind you, willing you and coaching you to get ahead faster. And the breadth of experience is incredible across our coaching team. So I would like to extend you guys an invitation to come along and see myself or one of the members on my team. I won't be offended if you don't choose me. I'd like to offer you a discount on the initial consultation. So the initial consultation, it's 90 minutes. We diagnose your starting point for you or with you. We understand your current trajectory, and we look at changes that you can make to get you there faster or opportunities that you might not be able to see. So it's a great session. It's a really good session for you guys to get a bit of clarity on what you might be able to achieve or any opportunities that you might be missing at the moment. So we normally charge $400 for the 90 minutes. If you book before the end of June, I'd like to extend a discount of $149. But I'm going to go a step further, and I'll ask for forgiveness later. I would like to offer you guys a super special $99 for this session, but you've got to book by midnight Friday. So you've got tonight, tomorrow night, Friday night. If you book in by midnight Friday, I will count that down for you to $99 for that 90-minute session. An absolute bargain. So you can scan the QR code, or you can go to our website and just say, Shelley said I could have a session for $99 and I've booked before midnight Friday. So I'm hoping, how are we going for time, Olivia? 45 minutes. I've left enough time. If you have any questions now, pop them into the question little box or the chat box if you can't find the question box. But there were some questions that my producer Olivia has collated. So do you want to start with those, Olivia?
Yes, thanks, Shelley. We do have a few questions that have come through. So the first one is, I am a recent first home buyer. Do you have any tips on keeping motivation towards the long-term goal of becoming mortgage free?
Yeah, and I hope you've picked up the learnings and the tips from today, whoever asked this question. First of all, congratulations for getting on the ladder. Amazing. That is no mean feat. So well done. However, you are now staring down the barrel of a very long term of a mortgage. So as I said in the session today, we want to break that mortgage down into achievable chunks. It seems insurmountable when you think about that long term, but it's less insurmountable if you break it down into annual, and even within that annual target, monthly targets for you to kind of achieve. So chop that mortgage up every year, shave bits off it, and attack extra bits of principal. It's a feeling of progress. And I think when you see progress, and you're killing these little chunks of mortgage, it's kind of like, I'm coming for you, and then I'm coming for you. You're chipping these bits off and you feel like you're getting somewhere. So you are saving compound interest, but there's also that motivation that you are actually making the progress. So that would be my advice to you.
Awesome, thank you. Next question we've got is any advice for single people on a mortgage? Given the current economic climate, how can I best move forward to support myself as a single person?
Yeah, and it's hard. And I've done a podcast recently on the singles tax. It's definitely harder when you're on your own because you don't have those economies of scale. But let that not be an excuse. You are also very light on your feet. You are also very dynamic. And you also steer the ship and can choose what you want out of life. So even though it's harder in a financial sense when you're on your own, you actually have a lot of advantages to the couples that I see because you get to make quick decisions. You get to make decisions that only affect yourself. So you are just going to have to work smarter to get ahead quicker. But I actually think there is a lot of advantage. So I think take heart in the fact that, you do have this flexibility. You could do something quite wildly radical if you wanted to kind of get yourself ahead faster. So I think there's a lot of advantage to being single, but yes, you will need to work harder. So the concepts I talked about today, again, identifying how much can I save, chop that mortgage up into savings targets and make those extra principal repayments.
Awesome, thank you. Next question is for an investment property purchased as part of a retirement plan, should I sacrifice some of my lifestyle now to pay it off as soon as possible, or should I feel at ease with the 30-year loan term?
This is a really good question, actually. And I would say, please live your life. We need to balance you living a happy life now. But I think why you're asking this question is there's a bit of unease about your retirement number and gap. So I think what would be really powerful for you is do the work or come along and see us so we can do the work with you to help identify your retirement number and whether or not you're on track or if there's a problem to solve. Because once you understand that problem that you need to solve, or there might be no problem, it gives you that peace of mind to allow you to enjoy your life now, knowing that your strategy will serve you long term, if that makes sense. So it sounds like you need a bit more knowledge about your numbers and your retirement plan so that you can understand what growth you need out of that investment property and how much you should pay that down by. So please don't put your life on hold while you're attacking debt. We must be living a happy life. When we talk about fritter, it's not things that you enjoy out of life. Like I wouldn't consider a holiday to be fritter, We want to make sure that you can live that happy life because we don't know how long you're going to live for. So it can be really good to have peace of mind for this person by really deeply understanding their retirement plan that will give you that answer around how much debt you need to pay off on that investment property. So if you can't do the calculation, come along and see us. We've got a retirement planning program that would actually cover that off. And often that program gives people that peace of mind around, I will be okay. I can still spend money now, but I'll be okay long term.
I don't want to own an investment property. Are there any other options?
Absolutely. And KiwiSaver is a really good option, but be careful with KiwiSaver. If you're a shopper and you know that you're not going to save, you're just not going to save moving forward. For some people, they actually just ramp up their KiwiSaver. The risk with that is you're locking that money away until age 65. So the key there is to go, what are my goals? Where do I need to get to? So, for example, one of your goals might be, I want to retire early. And it's like, okay, well, what does that retirement look like? How much do we need to build in terms of wealth? And are you going to get there on your current KiwiSaver, or is there something missing? So you say you don't want to buy an investment property, but do you have the ability to actually save your way there? So sit down, think about what your goals are, crunch a few numbers around that and understand where you need to land in terms of that wealth you need to create. So look, KiwiSaver is an option absolutely for kind of wealth creation. It keeps it tucked away until you're 65. Again, though, there's the risk of you might want to have fun before you're 65. You can invest in managed funds. With managed funds, though, you can't borrow to do them. So you need to be saving to have money to put into those managed funds, or shares, or any kind of index fund, or anything like that, or an ETF, or, there's lots of different investment options, but you ultimately still need the savings to put into that investment. So work out whether or not you can save enough for that to then start to compound for you. So yes, there are other options aside from property, but have you got the savings to put into those investments so that they can grow for you to serve you long term, if that makes sense?
Awesome, thank you. What are some tips if you were having to top up your investment property each week?
Yeah, and most properties to start with, you will need to top them up. And it's something that when we work with clients and they're buying investment property, we factor it into their plan. If you're frittering, we find that 15%, and that can help to offset the cost of that top up. But we need to know that you can sustain that top up. So for me, it's, well, what is the rent that's coming in? What is the mortgage interest? And if you've got a home mortgage, I would recommend that you go interest only on that investment property. What are the other costs associated with that property? So rates, insurance, property manager. Do yourself a little worksheet, and then I would divide it by pay cycle, and I would almost treat it like a bill. So you know that you're going to top up this property for the next 12 months on that level of rent and on that level of mortgage interest. So let's just add it in, automate it in with a pay cycle, and treat it like a bill. What tends to happen over time is that rents rise with inflation. And we did see this happening when inflation was really high a couple of years ago. Rents were actually kind of going up at quite a high rate. They're kind of softening off a wee bit now. But as rents tend to inflate over time, it means that the cost to hold that property should drop. So I think of it as a bill, work out what it is and tie it in with a pay cycle. That's kind of a practical thing that you can do. You've got the property now, but one of the key things that we help our clients do is buy the right property in the first place. So understand that that property, that you can afford to hold that property through a property cycle. If you're holding on to that property and it's not right for you, then possibly we need to think about trading it in for one that actually serves you. So that's a couple of options of things that you can think about with that rental property top up.
My parents are 61 and 59. They're almost mortgage free, but not a lot of KiwiSaver or savings. Do you
Yeah.
think they'd still be able to get an investment property, or would the bank be unlikely to lend at their age?
Yeah, and this is a common one. If you were coming to the bank and you were trying to buy your first home at 59 and 61, yeah, that's going to be a hard one. But actually with investment lending, they will lend because they understand that there's a exit strategy to it. There's an asset there that you're buying that over time will appreciate in value. So banks will lend. I mean, there is a window of opportunity where banks, they do get a little ageist. So there may be some conditions on that lending, but I've definitely had clients borrowing at age 60, 61, 62, sometimes even into retirement, depending on how much they're trying to borrow. So yeah, not insurmountable for them to do something like that. Timing will be key for those guys because we need to understand how long if they're mortgage free or not, and how long the KiwiSaver is going to last. So the hold strategy on the property will be the key for those guys. So getting the lending is one thing, but what is our strategy around how long we hold that property for, and how much can they afford to top up over that hold period in terms of when they retire? So there'll be some quite sort of precise criteria for your parents in that case.
We have time for one more question, Shelley.
Cool.
What do I expect from the initial 90-minute session with you, and what's to be expected after?
Yeah, so generally the initial session it's just a chance to look at where are you at now, where do you need to land, are you on track or not, and what would we recommend that you change. So it involves talking through your asset position, it involves articulating your goals and starting to kind of form, you know, an idea of kind of that life plan. So you think of your goals ahead of that session. Personal goals, I mean, like, I want to retire early. I want to have the ability to take my children on an overseas trip in a few years' time, those kinds of things. So we want to identify those goals. And the consultation also involves putting together a plan, a high-level plan. So it's not a huge amount of detail. We can't solve the world's problems in 90 minutes, but we're going to get an idea of what you're capable of achieving, and we're going to get an idea of what you could change or an opportunity that you could take moving forward. At the end of the 90-minute consultation, we talk about, does it make sense for you to continue to work with Enable Me in one of our programs? So we make our money as a business by running coaching programs, and we have a range of different programs, from first-time buyers to retirees and getting a retirement plan, mortgage killing, investment property programs. We would identify which one would be right for you and is there value in you doing it, and then you can decide, does that speak to you or not? And there's no obligation with that first session. So if it's compelling and you choose to work with us, we would then kind of press go on that program and start getting you being awesome financially.
Thanks, Shelley. I'll leave to you to
You're
wrap up.
welcome. Yeah, thanks. So for those of you that are here today, I hope I've been clear. The messaging is, do not rest on your laurels. We've got some headwinds with some lower interest rates. There are some amazing opportunities for wealth creation out there. Don't just talk about it, do it.